Hi everyone. Today's topic is property investment for beginners. And when I say beginners, I mean kindy stuff. This is ABCD of property investment. So for those of you who already have an investment portfolio, already know the lingo, you probably won't find as much value in this. But those who are yet to buy their first investment property or first property, you will certainly find a few good information in here. I hope so. None of this is financial advice, as always. This is just really sharing my experience, and what works for me may not work for you. The intention is not to really share the strategies, but to make you familiar with the calculations behind investing in property, as well as some of the common terminology that are used when you are looking to invest, because sometimes it can be quite overwhelming. I remember when I was looking for my first investment property years ago, none of these words that you see on your screen at the moment made sense to me. So this is more on math side than on strategy side. Um, the reason why I really wanted to put this together, just like the stock exchange video, more so than the stock market video, is I come across so many of my friends and people in my circle who are misguided by, I don't want to tag the whole industry, but misguided by people who are within the um, property related industry. So your brokers, your conveyancers, your real estate agents. Now, they all have a very biased interest. They will only make money if you buy your property through them. There is a lot of pumping going on, so they exaggerate the return, the investment, and that's why I really hope anyone who listens to this and goes through this next 10-15 minutes of content should be able to do your own calculation and assessment. Okay. Now, I'm not selling anything here. I have nothing to gain. All I'm doing is sharing my experience, and I already am a trusted advisor for a lot of people. The aim is to share what I know, and it's really up to you guys to where you take it from there. So just like the stock trading video, I had a lot of positive feedback, but at the same time, a lot of requests to make more advanced videos as well on technical analysis or strategies or scalping. Now, the aim is not for me to turn into a regular, um, on any investment forum, a regular video maker, content maker. I don't want to do this any more than I have to. My aim is really to make everyone familiar with the basics so you can go and do your own research. More than happy to have small ad hoc conversations around ideas. We can exchange ideas. But yeah, I'm not looking to open a university of any kind. Now, without a further ado, let us get started on property investment. Now, it's been a couple of years now, 3 years now, since I bought my last investment property. So I'm a little bit off touch from residential side. I've been investigating a little bit on the commercial side. So I basically, what I did, let me open up one page, is I picked a little bit random, but with a purpose suburb of Penrith. Now, why Penrith? Is I didn't want to pick one of those suburbs where median house price is $1.4 million because the video is really for first time investors and they're more likely to look for entry point of 600,000 to 750,000. To be honest, I didn't think I would find anything around 625. So yeah, this is a price guide only, so it may be 700,000. I don't know. But let's take this for example. Okay, and the numbers may vary slightly. Um, so this is, I'm not going to go into strategy, which suburb, what are the pros and cons. Let's just take Sydney as a whole. Okay. And then I did another search on a similar looking property in the similar street, nearby street, and the lowest rent I could find. Now there are similar properties around here which are for 550, but when we are doing the calculations, we always want to be conservative. We want to estimate our cost a little bit more than they are. We want to estimate our income a little less than they are. Now, we don't want to exaggerate them too much because otherwise a good investment property will look like really bad investment property. So let's get back to the Excel if I can find it. Okay, so with property, I personally look at 5-year and 10-year investment plan. So when I'm doing the calculations, I look at what the property value and numbers look like in first year, third year, fifth year, sixth year, and 10th year. First year because that gives you a snapshot of yearly numbers. Third, 3 years because that is what I call short term. So after 3 years, if the conditions are in your favor, if the numbers work out, you may consider selling it. So that's why 3 years. 5 years, just because it's a good number. Or actually 3 years also because every 3 years I increase 5% rent on my investment properties. So that's another calculation there. 5 years, 6 years, because after 6 years, that is another 5% increase coming, and 10 years. So let's look at year one. Okay, please ignore these random keywords here. This is what I want to cover. As we touch them, I'll cover them. I really just have written them down so I don't forget them because these are important. This will help you make a decision. Now, purchase price 625. As I said, it may be 700,000, doesn't matter. What we are working on is percentage. The reason why this is bold and bigger than anything else is because everything I do, stock trading, uh, residential property, commercial property, gold, ETF, anything, this is my bottom line. I want one number to tell me if it's a good investment or not, and that is this. Okay, so we'll come back to that. Um, let's take 625 for example. Those who are, guys, please don't pick on small things. Okay, I'll whip this spreadsheet together in less than 10 minutes, and there are a lot more columns which I've hidden, and they will come. As I said, the aim is not to give you a perfect calculation. The aim is to give you the method of calculating. All right, now I better get to the content. I want to keep this video short and sweet. So purchase price 625. You would put 10% deposit down. Now, I encourage everyone to put at least 20% if you can, not only to avoid LMI, which is lender's mortgage insurance, but also it's just a little bit of a safety net in case anything was to happen. But given current house prices are in $600,000 to $800,000 mark for a house, I've taken a scenario of 10% of your deposit and 90% of home loan. So 10% is 62,500. Stamp duty I've calculated to be $24,000. Legal, let's just say $2,000. So your total loan amount, which is 90% of the purchase price, is 562,500. Interest only, let's cover this. There are two main types of interest that they charge, the banks charge: interest only and principal plus interest. Principal plus interest pretty much means if you were borrowed $100,000 and the interest is $500 a year, they will obviously take that 500 as an interest, but out of 100,000 they also take $3,000, just giving you a rough number. So you basically reduce your loan amount as well as you pay your interest. Interest only means you are only paying the interest component. The loan amount stays the same year on year. Now, I would recommend, actually, I shouldn't recommend anything. I personally opt for interest only loans. One, because it will reduce your yearly liability of payments. See, the whole aim is to make your money work. The whole aim is to only pay what you must pay. The remaining money should be used at earning more interest from somewhere else, right? So interest only payments reduce your payments, and it's easier to do tax as well. Not easier, but it's easier to do calculations, personal tax calculations. Anyway, moving along. So actually, interest are also fixed and variable. Fixed mean for, let's say, if the fixed period is 3 years, for those 3 years, regardless of what interest rate changes come and go, your interest will be fixed. It will not change. Whereas variable means as the market interest rate changes, the bank will change, not exactly the same, but somewhat accordingly. They will either push it up or pull it down. So for this calculation, I've taken interest only 2.5%, which I think more or less is the current going rate. So that comes to $14,000 of our yearly repayments, and total investment is 88,000. Now this amount is very important. See why it's bold? This is the total of, so this is basically what you have put in. So you put in your deposit, you put in your stamp duty, and you put in some legal cost. So roughly 88,000. Now rent, as I said, I did find properties around there which were at $530 to $560 a week, but you want to factor in, in a year, a couple of weeks, it may be vacant over the time. Yeah, and some miscellaneous expenses, this and that. So you always want to count conservative. So I've taken the lowest one I found, which was 420 per week. So that comes to 22,000 a year. I've added other. So other is your insurance, council, water, bits and pieces here and there. So I just took a ballpark figure of 5,000. Management, if you rent it out through a real estate agent, roughly $2,000 for them to manage your property. Mortgage, so this is your interest only repayment at 14,000. Now cash flow. Cash flow means, well, the flow of cash. It can be positive, it can be negative. Positive cash flow means at the end of the year, a certain amount is added to your pocket, to your account. Negative cash flow means a certain number is taken out from your pocket or account. This cash flow is pretty much your rent, which is your only income from that, and minus your mortgage, and any other expenses. So basically 778 is your yearly, this is per year, positive cash flow. I would call this a break even. Let's not even worry about few $1,000s here or there. So this is a break even property, and that is very hard to find around Sydney. Some people may argue, but my experience is it's very hard to find good positively geared properties in Sydney. So this comes to neutral, right? So no profit, no gain, and this is your first year property price. So I've taken first year as neutral, right? So because you may have bought in July, August, September, October, doesn't matter. So first year we haven't factored in any growth. This is also a conservative calculation. So we won't track first year's property growth. Now let's talk about this number. So in Sydney, from what I believe I've read and my experience as well, property price pretty much doubles every 10 years if you are bought in a decent area. Some areas, for one or the other reason, have skyrocketed. So they would, in 6 or 7 years, double in value. Some areas are a little bit behind, so they may take 12 to 13 years. So double in 10 years is basically 10% return or growth per year. I've just taken 7%. So I've again here taken a very average number across Sydney. Hopefully we'll see better. And even after that, I've just not counted the whole first year of growth in that. Okay, let's look at year number 2. So year 2, of course, none of these changes. Your purchase price and all those expenses remain the same. What has changed is your loan amount. Now I have reduced $50,000 from the loan amount. This is your, don't break the formula. This is an assumption that you are saving $50,000, your household saving between the couple. You're saving $50,000 a year. Again, some may be 30, some may be 80, some may be 450. Doesn't matter. This is just a number that I thought is realistic for a household. It also comes down to savings, right? So if any of you think, oh, that is too much, then maybe start looking at savings. Where can you save to push this number up? So that goes down, and in return, your interest goes down as well. At the same time, for last few years, we've been very lucky. The interest rate have been either stagnant or gone down. But as I said, we always overestimate our expenses and underestimate our income. I've estimated this to go 25 basis points, so 0.25% every year. Okay. So the interest is up a little bit. Total investment remain the same. Rent is the same, or everything is the same, mortgage more. So basically, again 746. So we pretty much have the same cash flow, which is neutral. We have added 7% for year number 2 here. So that comes to 668, 750. This is just a number, right? This is your estimated market value. We'll come to that at the end of year 6. Park it for now. Year 3, loan goes down by 100,000 because 50K from last year, 50K from last year, 50K from this year. Your loan goes up a little bit, 0.25%. Essentially, you're in the same ballpark figure, $1,000. So neither plus nor minus. I wouldn't even count it. This goes up by 7%. Okay. Now, year 4 is my favorite because this is the first time you get to increase your rent. So 5% rent increase is quite conservative in my opinion. So that pushes it up another $1,000 or so. Your loan amount is again down by another 50,000 and your interest is up by 0.25%. So your cash flow now goes from 750 to 1,000 to 2,500 or 2,600. Yeah, this has gone up 5%. Now this is good, but again, I wouldn't even count it. Something can happen potentially, which will wipe this out, or you may have to put 2,000 extra on it, which is very nominal amount compared to the overall figure we are talking. So let's just call it neutral. Year 5, same deal, 50K of extra savings reduces your loan, your interest rate goes up a little bit, and you are around the same mark, 3,100. Year 6 is where you see some more colors. So year 6, same deal, now your total loan left is 300,000. Your interest is 4%. And yeah, your bottom line 3,380. Now this time, after 6 years but 5 years of 7% each year growth, your property price is 876 compared to 625 that you bought it at. So that is $250,000 of growth in 6 years, which is $42,000 per year. If you think about it, that's like $3,500 a month. So for those who've been thinking about investing in property and putting it off, every month is costing you about 3,500 in growth. Factor that in. 50% ROI. ROI is return on investment. We don't look at 7%. Because 7% is on the purchase price. We did not pay $625,000. What did we pay? $88,000. So if you are getting, and again, I haven't counted any of this cash flow. All I'm counting is growth. This is called capital gain. Your capital in the property has gained 7% a year for 5 years. So that is $44,000 per year for $88,000 of investment is roughly 50% return on your investment, which is really good. Okay. If you want to compare, Bank is lending you money at around 3 to 4% dollars, so a percent, not dollars, 3 to 4% sorry, cost. The bank is lending you money at 3 to 4% um, cost. If you can use that money that they are allowing you to borrow and generate 50%, that is amazing. In my opinion, if you can generate 10%, that's also very good, right? Anything even 1% is good, because 1% positive cash flow or positive income, forget cash flow, forget I said cash flow, please. 1% positive income or growth, yeah, sure, why not? Now, few assumptions. I haven't factored in LMI because I don't want to get into 25,000 here or there. Let's say this was 700,000. Okay, that will make you all happy that it's a realistic price. It has, if they have advertised for 700,000, surely you won't be buying it for 700. Hopefully, you'll negotiate 10, 15,000. So LMI, yeah, just make it. This is already more than 50%. Call it 51%. Doesn't matter. I've already covered 50K household savings. I actually may, this is one other thing where I find myself repeating over and over with few people I talk to. I may down the track do a video on this, the importance of this, not how to do it, but why it's so important. I have assumed 7% annual growth, 20.25% rate increase, every 3 years, 5% trend increases. By the way, year 7 is going to look even brighter. I would put it flow red because you'll be adding 5%. So this will probably turn into like $6,000 or $7,000. I've only factored in single property scenario. Now let me talk you guys through it. What we just discussed here, this is very linear. You put in the hard work once and then you're getting benefit of it year after year after year after year after year. If you wanted to, let's say 3 years down the track, you could say that from 625 to let's say 725, $100,000 increase in value. You can go to bank and refinance that, and bank should give you 80K. Let's say bank just gives you 60K. Okay, that's called refinancing. So bank is refinancing you, so your loan goes up by 60K if you borrow from them. But take this 60K and another 50K that you're saving, this 110K. Just like you invested 88K for this property, you can use this 110K to buy second property, and then you would have two of these line going at the same time, right? So I haven't gone through that because I thought that is a little bit advanced for people who are looking to just get into the property market. Another thing I want to cover here, let's go through all the keywords before I talk about this. Offset account. What's an offset account? It is basically your home loan. If you have this 50,000, you won't have 50,000 at the end of the year. You will be having $2,000 on regular basis, which will make up $50,000. You put them in offset account. Now this is for variable only, because remember, for fixed you are paying fixed interest on a fixed amount. The amount doesn't change. But for variable home loan, if you have let's say $500,000 worth of home loan, it doesn't make it 470. If you have $30,000 in that account, you won't be making it 470. You will leave it 500, but there is an offset account. So the way they calculate interest is basically they will charge 3% interest here, but give you 3% interest here. So essentially you're paying on 470K. Okay, so that's offset account. The strategy here should be, once you have any home loan that has an offset account, every single dollar should be sitting in here. You pay all your expenses through credit card, paid back in 45 days, so you don't incur any interest. But for those 45 days, your money will be sitting here. It may just be a few $100s, but it all adds up at the end of the year. Comes down to savings. Okay. Negative gearing and positive gearing. This is a positively geared property. All that means is it has a positive cash flow, which means the taxman will say, give us 25%, 30%, whatever your tax bracket is, give us that much out of this much of your profit. They won't ask you for the growth in here because you haven't sold it yet. We will cover that. I have it written down as well. So that is positive gearing. What is negative gearing? A lot of people buy property, investment property, just because someone has told them you can reduce your tax liability. It is true, you can reduce your tax liability, but in my opinion, your focus should really be on increasing your income and decreasing your expenses. Tax is one of them. Decreasing your taxes should not be the goal, because that only means you have bought a heavily negatively geared property. Because assume this is, let's say the rent is only 19,000. Now when it goes into minus, that means it's negatively geared, and you basically, if your yearly income is 100,000, so you take away this, so basically 100,000 minus your 2,000, so you basically pay tax on 98,000, not 90. So yeah, you are saving a little bit on your tax, and you are not saving 2,000, by the way. You are not saving 2,000. You are saving 25%, or whatever your tax rate is. Assume it's 25%. You are saying 25% of this, right? If it's positive, like it was before, you are paying 25% on this. It's not a huge number. This should never be your motivation to invest in a property. Okay, so that's that. Negative gear, positively gearing, done. Growth on full price. Now this is where leverage is useful, right? So you have invested 88,200, but the growth is not on 88,000. The growth is on full amount. That's why if you do the same calculations with 20% deposit down, the ROI will not be as good, because your investment will go up significantly. The 62,000 will become 120,000. This will become 140 to 150,000. So that's a different calculation. If any of you want this spreadsheet, just email me. I'll put the email somewhere in the description. I'll figure out a way. Or just send a message and I'll send you the spreadsheet. You can play around with the numbers. It's really straightforward, very basic. So the reason why I put growth on full price is because it's easy to oversee and not factor in that the growth you are getting is on full amount, but you have only invested a part of it, 15%, right? So that's that. Fixed versus variable. I think I covered that, or I may not have. Yeah, I did. Fixed, variable, interest only. I did cover them. Cash flow, I did. So this is important. Positive cash flow, negative cash flow. Capital. So this is okay. That's I only put this here because it's a terminology thing. The growth here is called capital growth. When your price goes up, it's capital growth. When this goes up, it's cash flow, positive cash flow growth. So that's why I put them there. Conservative, just as I said, always have your numbers conservative on both sides. Income should be counted a little less, expenses should be counted a little more, but not too much. I used to do that mistake. I used to factor in 15% variation both ways, and then I would see a really small number, which will seem like it's not worth doing any of this, right? Refinance. So I covered that. You could buy another property by taking advantage of the growth that has happened. Sell CGT goes hand in hand. So you know how I said the taxman will ask you for his share for every dollar that you put in your pocket every year. This dollar is not put in your pocket until you sell it. Now, I'm not an accountant, I'm not a tax agent, so double check this. But basically, my understanding is if you hold a property for less than 1 year, as in you bought it in January, sell it in October, and you make $50,000, you pay tax, capital gain tax on full amount. If you hold it for more than 1 year, whatever gain, let's say in just 8 months you manage to get 80,000 of growth. Okay, so you pay on full 80,000. You pay tax on full $80,000. Let's say in 1 year, 2 months, the growth is 100,000. Is that 100? Yeah, 100,000. You get 50% CGT exemption, which means you only pay tax on 50,000. So that's why it's important to know that even if it's on 50,000, that's, you are not pocketing all this money. This is where the rosy picture comes. Not everyone tells you. A lot of people stop at 50% ROI, 42,000 per year passive income. One, it is not income, it is growth. There is a big difference. The difference is cash flow. You can't use even $1 of this amount until you sell or refinance. So it's not income, it's growth. And so basically, I am of the opinion that I don't sell at all, right? This is a good vehicle that will only get better with time. So that's why I did all 6 years. So you can clearly see the pattern. Cash flow going up, property price going up. Now it will not go up every year, but this is an average, right? We are just doing numbers on the paper. So that's refinance, sell, CGT, dual occupancy. Now, if you're really savvy, what you will be looking for is, let's say this house is a little forward. The front yard is not as big. And let's floor part, it doesn't matter. And at the back, they have a big room. Now that's why I like Western Suburb, the Penrith side area, because the blocks are a good 700 square meters. You could build a granny flat at the back. Now, granny flat, this is a whole different calculation. I won't get into that. But let's say granny flat costs you 150K and it puts, let's say, $150 per week. This is completely made up numbers, yeah? So do your own research. If investing 150K gives you 7,800 per annum, that's your calculation. You can decide whether to do it based on these two numbers. But that's what we call dual occupancy. Now you need council approvals, and there is a whole process. Find a builder, get approval from council, DA, this and that. Don't just buy a big block of land assuming you can build on it down the track just because there is room at the back. But if it's dual occupancy, it increases your return on investment significantly, both cash flow as well as property growth. Diversification, I should probably put it here and come back to it. Savings, as I say, this is all good, but a lot of you, I won't say a lot of people, I'll say a lot of you, because I know a lot of you, this is where you really need to work on. And I'm not saying change your lifestyle where you're living on bare minimum, but I'm just saying understand the difference between spending and, I may get a bit of a backlash here, but wasting money. Okay, just be money wise. How about we put it nicely? Be money wise. Don't be money stupid. Commercial real estate. Now, flip this and assume that a lot of growth here, let's say 7% growth here every year. Okay, so you're seeing thousands of dollars on your investment coming in your pocket, but this remaining stagnant. Okay, so you don't get much capital gain because commercial real estate is high in price as it is. Plus, the buyer market is not as big. You won't find as many shops as you will find houses or units. Actually, before I forget, houses or units. So that's why there are not as many buyers for shops or offices as there are for units and houses and townhouses and villas. But um, commercial real estate makes money for whoever is leasing that place. So you usually get good return on your investment in terms of cash flow. More on that later, not today. Um, Now, I wrote down unit because I forgot to mention one important point. Now, this is more aligned to strategy and not numbers, but I'll mention it anyway. If you are contemplating whether you should buy a unit or a house, I won't give you any advice, but I will say consider the difference in expenses. So, you are paying strata, you are limited to what changes you can do, right? So, like I said, dual occupancy. You got lucky, you didn't know, and you have a big enough block where you can do something at the back. If it's a unit, even if you got a big unit by fluke, you can't do anything there. There is strata, which adds up to the cost. So that's extra cost. They are cheaper, that's the pro. Units are relatively cheaper. But if you calculate price per square meter, as in divide the total price by how many square meters of place you're getting, houses are cheaper. You get more value for your money. There is more growth. Okay, so I'll leave it there. Commercial value add. Value add is not adding another granny flat at the back. Value add is, for example, where is our house? Value add would be painting the roof, painting the inside of the house, changing the kitchen cabinets, changing the light fittings, changing this door. These things, and I enjoy this process more than anything else. You spend $10,000 wisely and you get $100,000 growth in 1 month or 2 weeks, however long it takes to renovate. Now, the reason why I was a little smart there and said wisely is because not every renovation, not every value add is going to increase the price. If you dig a big hole at the back and put a $10,000 swimming pool and put $3,000 glass fence at the back in Penrith, for this house without doing anything else, that's not a wise spend of money. Okay. So do your own research. Happy to talk more on that from my experience, but value add will change a lot of numbers. See how I was increasing the rent 5%? If it's in the right street and right suburb, you can spend as little as $10,000. I won't talk about my experience. As little as $10,000 and increase the rent like 15%, right? It all comes down to when you're buying the property, you have to have those glasses on where you're not just seeing the property as it is, but potential of the property as well. Okay. I often say I would much rather buy the worst house in the worst street cause a little bit of touch and it's now a really good house on the street. Whereas if it's a best house on the best street, you have this. That's the resistance in stock video that I did. It's very hard to break that ceiling. Whereas if you're down here, a little bit of an effort and you're already better than anyone else. Okay, off the topic a little bit. Paying off debt. Now, another strategy is not to reduce this. You leave it there because it's not making huge difference in your end result anyway. Yeah, your interest is rising. So instead of plus $1,000, you may be minus $2,000. Yeah, if you don't add those 50K every year, you could take those 150K across these 3 years, buy another investment property. Okay, so paying off debt is not always a good thing. In fact, that's one of the biggest challenge I had, right? So the traditional mindset and understanding is if you borrow money, pay it off ASAP. So with my first property years ago, that was my mindset, and I was paying it off very happily, thinking, oh, in 6 years, 7 years, I'll own it outright, this and that. But as you do all these calculations, you're better off borrowing money at 3%. Right now, it's at 1.98% or something like that. It's like free money if you factor in inflation. So paying off debt is not always a good thing, in my opinion. Your opinion may be different, your experience may be different. I don't know. I'm just saying what I feel is it's better to keep that um, borrowed money and use it somewhere else to generate more return on investment. Okay. Now, lastly, but most importantly, this has been my compass. So, any investment I do, now I don't know if I put in diversification somewhere. Yeah, there it is. So, it's important for me, and I've learned this from experience. Anything I say, I've learned this from experience. I don't have a lot of experience. Whatever experience I have, I'm sharing that. I'm still learning a lot from others' experience. So by no means I know it all. The diversification is very important. 2008 property market was heavily impacted. Okay, if I did not have shares at that time, I would have panicked. Stock market got hammered last year. If I did not have property and some investments in gold, some other investments, business, I would be panicking. So things happen to each sector. We would have never thought of COVID 2 years ago, right? But it happened. So anything can happen anytime. So that's why I have few doors open. So if one or two closes, you still have few doors open. Now, this is your guiding. This is my guiding compass. What I look at is any amount that I invest. What is the ROI for me? And I look at two things: capital growth as well as cash flow. The issue I have with capital growth is you can't use it. Let's say this is just one property, right? Sorry, I broke my Excel. This is just one property. Let's say you have five of these. Okay, every year you're buying one, and at the end of year five, you have five properties doing 42,000 per annum growth every year until you sell them or refinance them. You can't do anything with that money. The moment you sell them, you are losing part of that amount. Okay. For me, this is much more important, much more important, because every year this is putting money in my pocket, which I can use to invest somewhere else. Okay. Return on investment is percentage, so it's irrelevant of investment amount. It could be 6,250,000 or 625. The percentage tells me what is my return on investment. Passive income, um, again, it's more strategy, so I probably shouldn't cover it now. But passive income, sorry, selected wrong row, is, in my opinion, far more important than anything else. Because let's say you are doing really good at this, okay? You still have year on year responsibility to pay off this amount, okay? Or this amount, whatever the amount is. Let's say, and I may sound harsh, but let's say you disappear from the face of the earth after year three. Your family will not have the same income. It will be divided by two. Your expenses will remain the same. They will not divide by two. So you don't want to build on too much liability. You have to build on some liability because it's necessary for growth, but not too much. Whereas if you're building passive income, let's say if this was a commercial property and that's where I'm leaning more now. I've got some really good momentum in that area now, and that's what gets me excited. That if I am not around after even year two, X number of money will keep coming in the family bank account. So that's a big difference. Okay, diversification is really risk management. I think I've covered everything I wanted to. This is not very comfortable for me just talking by myself. I'm used to interacting with people. But at the same time, the response from the stock market video was really good. And I appreciate everyone for your appreciation. And that got me motivated to do this one as well. Where it helps me is I've been repeating same thing over and over to a lot of people on their request, mind you. I'm not going and telling everyone the same thing, whether they want to hear it or not. So this way, at least they have, I'm covering them all in one go. The numbers are here. People can go through it, make changes to whatever you need to. This is just a format I'm giving you. And yeah, we'll cut it short there. Still ended up being, how long is it? 46 minutes. Wow. It's past midnight on Thursday. I was going to trade US stocks, but didn't feel like. I thought I'll, skip today and I'll do a quick video. But ended up, um, yeah, ended up 45 minutes later. Ended up talking over and over on the same thing. Anyway, thanks everyone. Feel free to message me. Don't spam those two groups that we have. Just maybe send a message here or my email address. The reason why, the reason why I named the channel Generation Wealth is because that's my focus for last couple of years now. It's not about generating revenue, because to generate revenue, I have to be here. Even if I'm here, I have to do something. The aim is, for me, the aim now is passive income. What can I do in next 1, 2, 5, 10 years so that after 10 years, I don't have to look at anything, right? Someone can argue, this is nothing, or this is nothing. I can make 5 times that amount by doing X, Y, and Z. My question is, can we do that without any interaction, zero interaction? And the answer is always no, because a lot of businesses are essentially jobs. You pick a project, you work on it for 2 to 5 years, you finish that, get a good return, but then you have to find another project. I'm talking property. In business, you are constantly growing if it's a good business, but you also have a lot of uncertainty and you have to be there to manage that business. So I'm not saying this is the only passive income. In fact, this is probably one of the most secure but least effective. Um, Most secure because this is real estate. This is real. The building will be there whether you're there or not, right? This is as real as it gets. So I will, if hit me up if you have any specific questions, if you want to discuss some strategy or commercial, passive income, whatever else. Happy to share my thoughts on it. None of these is advice. So please, please, please do your own research. A lot of mortgage brokers, a lot of real estate agents, they are your best friend, but they have their own interest as well. They only make a dollar if you borrow. So their interest is you buy something, anything, this thing or that thing, just buy it from me or with me. So I get my X amount. So please do your own research. As I said, the aim is whether it's stock market, this one, or anything else. We can talk ETF, whichever, whatever we talk investment. The aim is to give everyone enough fundamental understanding that you can then go out there and do your own research, not that you keep coming back for more information, right? So Just like stock trading, I've shown the basics. Once you get to that point, we can share notes on how I trade every day and how you trade every day. But we don't want to turn this into an educational channel. This is really a very private channel for a limited people that I know. And yeah, just sharing ideas. I would love to hear your ideas. Please share how you do things differently. I would like to learn something different as well. Okay. All right, everyone. Thank you very much, and see you in next video.